folks, we're going to talk accrual basis of accounting and do some critical thinking skills with adjusting entries. So let's start with accrual basis of accounting. Remember, we want to recognize our revenue when we earn it. So that's why we do adjusting entries, is to get the revenue in the period that it's earned. Accrual basis of accounting also says we want to recognize expenses when they are incurred. Again, which is why we are doing adjusting entries, so that we can recognize the expenses when they are incurred. So let's look at each individual adjusting entry. So let's look at adjusting entries for prepaid expenses first. So the definition of a prepaid expense includes the cash has already been paid, prepaid, that's what that means. It was recorded as an asset when it was paid. So the original entry debited a prepaid asset right here and credited cash. And the third part of the definition is before the asset is used or consumed. So the reason we're going to do an adjusting entry is because some of that prepaid asset that we prepaid for has been used or consumed. So the adjusting entry then is going to record the expense for the use of the asset and credit the prepaid asset that we set up. If we do not make this adjusting entry, then on the financial statements at year end, the assets are overstated, which means they're too high, and the expenses are understated, which means they're too low. So let's apply some critical thinking skills to this. If our assets are overstated, okay, so I'm going to do prepaid expense, the asset is overstated, and I'm going to show that the expense is understated right there. I don't want all that highlighted. Okay, assets overstated, expense is understated. So now I can apply this to the rest of the financial statements. On the income statement, our revenues minus our expenses are going to equal our net income. So revenues have no effect. If the expenses are too low, then that makes net income too high. Okay, in the net income, it will end up in our stockholders' equity section. So whatever the effect is on net income, excuse me, you're going to end up with the same effect in your stockholders' equity account. So if net income is overstated, equity is overstated, assets are overstated, liabilities are not affected, so your asset equal liability plus stockholders' equity basic accounting equation will still balance. Okay, I hope you got that. Let's try another one. Let's do prepaid revenue. Okay, in the definition, cash is received and it's recorded as a liability. So the original entry, cash is received, and we record a liability by using an unearned revenue account of some sort. And in the definition, we receive the cash, we record the liability before we earn any revenue. So under accrual basis of accounting, I want to recognize my revenue when I earn it. So the reason I need an adjusting entry at year end is to record some of that revenue that we earned and get rid of the liability that's been used up. If I don't make that adjusting entry, then my revenues are not recorded in the proper period, so they're too low, they're understated, and our liabilities haven't been removed, so that means that they are overstated. So critical thinking, let's apply it to the whole set of financial statements. For prepaid revenue, liabilities are overstated and revenues are understated. I always start with my income statement. If revenues are too low, no effect on expenses, then net income is too low, understated. If net income is too low, then so will stockholders' equity. And if there's no effect on assets, liabilities are too high, it's offset by the understatement in stockholders' equity, your basic accounting equation will still work. Okay, let's go to the next one. Accrued revenue. Again, We want to recognize our revenue in the period that we earn it. So the definition for accrued revenue, we have not received any cash. The revenue has already been earned, but it's not recorded. So we have no original entry at all. So what we have to do then is we have to record our revenue and increase an asset for accounts receivable because we haven't received our revenue yet. So if we do not make that entry, then we didn't record the receivable, so our assets are understated. If we did not record the revenue, our revenues are understated. So for accrued revenue, assets are understated, revenues are understated. No effect on expenses, and net income is understated, which makes equity understated. So assets equal liabilities plus equity. It should still be in balance. Okay, and the last one, accrued expense. Okay, again, we want to recognize the expense in the period when it's incurred. So in the definition, no cash is paid, but the expense is incurred. And it's not been recorded. So our job is to record the expense in the period that it was incurred, even though we haven't paid it yet. So there's no original entry. The adjusting entry will need to debit an expense and credit a liability because we owe the money. If we do not make that adjusting entry, then we did not record the expense, so our expenses are understated. If we did not make the adjusting entry, we didn't record a liability, so the liabilities are also understated. So coming down here, accrued expense, liabilities are understated, and expenses are understated. So no effect on revenues minus expenses that are understated makes net income overstated. If net income is overstated, so is stockholders' equity. And the understatement in liabilities combined with the overstatement in equity is going to equal the no effect on assets. Okay, I know that went pretty fast. I hope you caught it. Make sure you pay attention to the examples that are in most textbooks. They're in the one I use right now for sure. But the definition is important. The original entry, the adjusting entry, and the accounts, what's wrong with them before you make the entry are really important, along with why you're doing it to begin with. Okay, good luck with adjusting entries, and I'll see you next time. Bye-bye.